Canada's big banks have reported their last quarter of the year, and our next guest says that when you take a look at the valuation, for the most part, they are at or over what might be fair market value. Mario Mendonca is Managing Director with TD Cowen. He joins us now to talk about some of the analysis. Mario, good to see you for the last interview of the year. I want to start with maybe what I just finished with when I was introducing you. You talk about the valuations perhaps being vulnerable at this point. How come?
Over many years, while I've watched these banks, I've come up with a few valuation approaches. Some of them are extremely simple, just your forward PE. Others are a little more involved. They include an interest rate element of the valuation. But rather than going into the details, they're all sending me the same message. This is unusual valuation territory. Probably the most basic one is looking at your forward PE multiple. On 2025 earnings, we're a little over 12 times. You can sort of splice it and dice it in different ways and come up with different valuations. But ultimately, we're in sort of unusual territory. What surprises me is that we are at these higher valuations while credit losses are still getting worse. Now, that might be one of the big controversies for 2025. How much worse? But based on a number of valuation metrics like forward PE, equity risk premium, price to book, the valuation metrics that I've relied on over the very long term are signaling this is kind of a heavy valuation period. It's not unique to Canadian banks, though. I think the same is true for life insurance in Canada. It's probably true for a lot of sectors in Canada and the US. Everything, and certainly the banks, the valuation appears somewhat vulnerable.
What was, we'll get into like each individual name, but PCLs you mentioned might be still ramping up, more so for some banks than others. Earnings quality, is it what you see?
Well, credit losses are rising, but they're rising very gently. Each quarter we see 5-6 basis point increase in the impaired loan PCLs. Now, that's not true for BMO. The losses there have been ramping up much higher than their peers, but that's the sort of trend we're seeing. I think it's important to highlight that credit losses are not the only credit metric we focus on. Certainly they're moving higher, but things like delinquencies, the trend in gross impaired loans, a lot of loan categories are showing some strain. And I want to be careful when I talk about this. I think the most popular thing for people to say is that because of the significant increase in mortgage refinancing activity in 25 and 26, that mortgages will be a problem for Canadian banks in 2025. I don't believe that's true. I don't think that's the way it works. I think Canadians will do their best to stay current on their mortgages. We'll see higher delinquencies. The issue I see is that as mortgage payments rise materially throughout 2025, it'll have the effect of crowding out other payments or spending. So you might see higher delinquencies in auto loans, personal loans, lines of credit, credit cards. And that's what we're starting to see already. So that's the area of stress I see emerging in 2025. Not mortgages, but mortgages causing stress elsewhere.
Mario, well then let's talk about one of the individual names. You mentioned BMO earlier, and you say in your note that they delivered a very weak quarter, and I think the fourth consecutive quarter where PCLs led to a material miss.
Yeah, I can't imagine a worse PCLs year than what we saw to BMO in 2024 relative to the peers. What is normal is to watch every bank's credit losses move higher, but what was so unusual about 2024 is that BMO's credit losses marched higher throughout the year while credit losses were deteriorating but relatively stable at the other banks. It was the extent to which BMO differed from their peers on credit that really caught a lot of us off guard. But what's interesting about this is the stock has been perfectly fine. If I told you on January 1 this year that BMO's estimates for 2025 would be down 18%, I think we all would have concluded the stock would be a lot weaker. Stock's up 5 or 6% year to date. That's unusual. The market's clearly making a bet that BMO's U.S. exposure will be the place to be in 2025. So there's been a shift out of some less U.S.-centric banks into BMO, but there's no doubt BMO's quarter and BMO's year from a credit perspective, probably about as bad as I've seen on a relative basis. Certainly, I've seen periods in every bank's credit is weak.
And you've got a hold on that one, just to let people know, of which you downgraded back in August. Let's bring up, talk about National. What did you think of the quarter, and what do you think of their prospects?
Yeah, National delivered an inline quarter, but there were signs in National's results that caused the stock to be a little softer lately. They warned that financial markets results, which is a very important part of their business, the capital markets business, could be softer in 2025 than 2024. And that's a big deal for National. The Cambodian business, not only did we see credit losses and gross impaired loans in Cambodia rise, but we also saw loan growth slow. And on the call, the CEO suggested that the bank would be open to partnering with another bank in the region to lessen its exposure to Cambodia, but also to maybe help use that partner to help grow in the region. I think that's an indication that nationals become, or Cambodia's become far too big a portion of nationals' overall results, and it makes sense that they would slow that growth somewhat. The acquisition of CWB, which is still expected early in the year, probably helps that business mix a little bit. But looking at nationals, gross impaired loans in Cambodia, the slowdown in financial markets, and relative valuation supports looking to other stocks for better upside in 2025.
All right. Speaking of better upside, I think Scotia is one that you had more recently upgraded to a buy. What did you see in the quarter there?
I'd call Scotia's results at best in line. They were a little weak. I think the guidance around Latin America being slower in 2025, Mexico in particular, probably hurt the stock a little bit. The call on Scotia is slightly longer term than that. The argument is that Scotia is the lowest valued stock in the group of the banks that I cover. It's seen one of the most significant deteriorations in ROE over the last 5 years. And the argument I'm making over the next couple of years is Scotia will deliver the best ROE improvement of the group, driven by things like lower rates and the effect it has on their wholesale funding costs. And Scotia is the most wholesale funded bank in the sector. So lower rates, I think, have a better effect on Scotia than their peers. But there's also the benefit of the KeyCorp deal. I think that adds about 40 basis points to ROE, better expense control at Scotia, maybe even an announcement of a buyback sometime in 2025. That could also help the story. So I look at Scotia, and for me, that's a sort of a mean reversion story, much the way Manulife recovered from the doldrums and had a very strong 23 and 24. That's sort of the call I'm making from Scotia. It'll be one of those mean reversion names, not just in how the stock performs, but also their fundamentals.
Interesting. What about CIBC? Again, this is another one you upgraded to a buy from a hold a while ago. But this is one also that you actually explicitly say is attractively valued relative to its peers.
Yeah, so that upgrade was back in March 1 of 2024. CIBC had delivered several really good quarters, but the stock wasn't being paid for it. It was still trading a discount. That's all changed. CIBC is the best performer of the year. It's now trading in line with the group. So I wouldn't call the valuation necessarily attractive. But in the context of some very good underlying performance, I want to stick with this name going into 2025. What I mean by the strong underlying performance is their credit picture has improved. They had higher losses in U.S. commercial real estate, which have since subsided. Their operating leverage is among the highest in the industry, the strongest pre-tax, pre-provision profit growth. They're buying back stock. There's not a lot to dislike about the stock. There's a lot to like about CIBC right now. And where that valuation is sort of middle of the road supports sticking with that stock.
Okay, and let's round up. And I should mention, of course, we're not talking about TD for obvious reasons, but let's talk about Royal. Again, this one was more recently downgraded to a hold, I'm assuming on valuation. What did you see in the quarter that has you either reinforce your thoughts or has you maybe thinking a bit differently?
Royal delivered another very typical Royal quarter. It was a solid quarter. There was a little bit of stress going into the quarter. There was some concern that credit losses can be higher. We didn't see much of that at all. So I think they delivered another good quarter for Royal. The downgrade of Royal is almost entirely valuation based. In a sector that I think looks vulnerable, as we talked about early, Royal's the leader. It's got the highest valuation of the group, a very significant premium to the group. There are plenty of reasons why I think there'll be some mean reversion into 2025 away from some of the underperformers or into the underperformers away from the outperformers. Now, from a more fundamental perspective, I do think that Royal will see a little bit more credit stress in 2025, largely because 2024 was nearly perfect from a credit perspective. It's very hard to deliver that strong a credit result when the overall market is deteriorating. I also think tax rates are going to be a lot higher in their capital markets business because of the global minimum tax. So there's a couple of headwinds facing a bank that trades at a meaningful valuation. But I want to be very clear on this. It is difficult to downgrade a stock like Royal. It's been a very strong performer over the long term. The downgrade, I want to be clear, is largely a valuation-based argument.
What are you going to be watching for the upcoming year for all the banks, and maybe which ones have more tailwinds or headwinds? I mean, we are coming into, a politically volatile time, an economically volatile time. So what does that mean? What are you watching?
There's two big themes I think that are coming across, and I've recently spent time in the U.S. speaking to a lot of U.S. investors. One of the things that they were most sensitive to was how will Canada's economy behave relative to the U.S.? The consensus view among the Americans I've been speaking to is that the U.S. economy is going to be a lot stronger. Canada's going to falter either because of just these mortgage refinancings or maybe it's tariffs coming out of the new administration. But the view is that Canada will suffer relative to the U.S. So the theme seems to be buy the US name, sell the Canadians. That's one of the big broad macro themes that's clearly coming out when you speak to the US investors. The other controversy is credit. Is credit really going to behave that easily? Will it just sort of peak in the next couple of quarters at a modest 45, maybe 46 basis point level, and then modestly decline from there and everything will be great? Or will we have a real credit cycle somewhere in the neighborhood of 65, 70 basis points? That's the other big controversy. What troubles me about the banks right now is they're priced for a very modest credit cycle. The market is pricing in nearly a perfect scenario where credit losses rise and then decline from there. That's dangerous because anything that deviates from that really tidy scenario could see some downside in the stocks.